After a long and patient wait of 18 years, the global credit rating agency Standard & Poor's has finally decided to upgrade India's sovereign credit rating. On the 14th of August 2025, S&P lifted India to BBB from its long-held BBB status, a move that, while celebrated, has been widely described as fashionably late. This upgrade is not merely a technical adjustment on a financial ledger. It is a significant international acknowledgement of India's robust economic journey and its steadfast resilience. For a nation that has navigated a series of profound global and domestic shocks over the past 2 decades, this recognition, however delayed, serves as a powerful validation of its structural reforms, prudent fiscal management, and unwavering growth trajectory in a world often beset by uncertainty. The decision by S&P makes it the first of the major troika of rating agencies, which also includes Moody's and Fitch, to positively reassess India in the current economic cycle. This is a big deal. For years, economists, policymakers, and business leaders in India have argued that the country's fundamentals were far stronger than its credit rating suggested. They pointed to a stable democracy, a burgeoning domestic market, and a series of transformative, if sometimes disruptive, economic reforms. The upgrade finally aligns the agency's official view with a reality that has been evident on the ground for quite some time: that India has cemented its position as a formidable engine of global growth, capable of weathering storms that have capsized many other economies. This is more than just good news for the government or for the financial markets in Mumbai. It has tangible, real-world implications for the entire Indian economy, from the largest conglomerates seeking international funding to the smallest businesses that benefit from a healthier economic environment. It signals to global investors that India is a safer and more attractive destination for their capital, potentially lowering the cost of borrowing for both the government and the nation's corporations. The stable outlook accompanying the upgrade further suggests that S&P believes this positive trajectory is sustainable, providing a degree of confidence that will ripple through every sector of the Indian economy and bolster its global standing. The timing of this announcement, coming as it does amidst fresh global trade tensions, including the looming threat of significant tariffs from the United States, is particularly noteworthy. It underscores a core strength that S&P has now formally recognized. The Indian economy's resilience is largely powered by its vast domestic demand. While exports are important, the nation is not as vulnerable to external trade shocks as many other export-oriented economies. This inherent strength, combined with a clear path towards fiscal consolidation and a well-managed monetary policy, has finally tipped the scales, prompting an upgrade that many feel was deserved years ago, marking a new chapter in India's economic narrative. At its core, a sovereign credit rating is simply an assessment, or a report card, of a country's ability and willingness to pay back its debt on time and in full. Think of it in the same way an individual has a credit score that banks look at before giving them a loan. Global rating agencies like S&P, Moody's, and Fitch conduct detailed analyses of a nation's economic health, its political stability, its fiscal policies, and its overall institutional strength. They then assign a grade, represented by a series of letters like AAA, BBB, or C, which communicates the level of risk associated with lending money to that country's government. A higher rating signals lower risk, while a lower rating indicates higher risk. This grade is incredibly important because it acts as a crucial benchmark for international investors. Large pension funds, insurance companies, and global asset managers, who control trillions of dollars, often have strict rules that limit their investments to countries with a certain minimum credit rating, known as investment grade. India's BBB rating places it firmly within this category. A higher rating makes a country a more attractive destination for foreign capital, as it suggests stability and reliability. This influx of investment is vital for funding infrastructure projects, expanding businesses, and creating jobs, forming a virtuous cycle of economic development and prosperity for the nation. Furthermore, the sovereign rating directly influences the cost of borrowing for the entire country. When a nation has a strong credit rating, it can borrow money from international markets at lower interest rates. This is because lenders perceive less risk and therefore demand a smaller premium for their capital. This benefit extends beyond the government. It also lowers the borrowing costs for the country's corporations. When the government, the safest borrower in any country, can borrow more cheaply, it sets a lower floor for interest rates, making it less expensive for companies like Tata, Reliance, or even smaller non-banking financial companies to raise funds for their expansion and operations. Ultimately, a credit rating is a measure of trust and confidence on the global stage. It is a powerful signal that transcends complex economic data, providing a simple, standardized measure that investors worldwide can understand and act upon. An upgrade like the one India has just received is a resounding vote of confidence. It tells the world that the country's economic management is sound, its growth prospects are bright, and its commitment to meeting its financial obligations is unwavering. This enhanced credibility not only attracts investment, but also boosts national pride, reflecting the culmination of years of hard work, reform, and disciplined economic stewardship. India's economic story over the last 2 decades is one of remarkable resilience. The country has been tested by a relentless series of severe shocks, any one of which could have derailed a less robust economy. It successfully navigated the turbulent waters of the 2008 global financial crisis, a catastrophe that brought many developed economies to their knees. More recently, it endured the unprecedented disruption of the COVID-19 pandemic, a global health crisis that triggered lockdowns and shattered supply chains worldwide. Despite these immense challenges, the Indian economy demonstrated an incredible ability to absorb the impact, recover, and return to a path of high growth, showcasing a deep-seated strength that rating agencies have been slow to acknowledge. Beyond these global crises, India has also undertaken significant and often challenging domestic reforms. The implementation of the Goods and Services Tax in 2017 was a monumental structural change aimed at unifying the country into a single market. While its initial rollout caused temporary disruptions, it has since streamlined taxation, improved efficiency, and increased transparency, contributing to a more formalized and resilient economy. Similarly, the demonetization exercise in 2016, though controversial and painful in the short term, pushed the country towards greater digitalization of payments and brought more people into the formal financial system, strengthening the underlying economic architecture over the long run. The resilience is also a product of a well-calibrated policy mix. The Reserve Bank of India has played a crucial role, with an enhanced monetary policy framework that has successfully worked to anchor inflation, even during periods of global price volatility. This has been complemented by the government's commitment to fiscal consolidation, a disciplined approach to managing its budget and reducing its debt burden. Rather than succumbing to populist pressures for unrestrained spending, there has been a clear focus on improving the quality of expenditure, with a significant push towards capital investment in infrastructure, which creates long-term assets and boosts future productivity, rather than just funding current consumption. This journey has not been without its difficulties. Each of these shocks and reforms came with its own set of challenges, causing short-term pain for citizens and businesses alike. However, viewed collectively over the span of 18 years, they paint a picture of a nation that is not afraid to take on tough challenges and make difficult choices for the sake of long-term structural improvement. It is this proven track record of weathering storms, both external and self-induced, while continuing to reform and grow, that forms the bedrock of SP's long-overdue decision to upgrade India's sovereign credit rating, finally acknowledging a resilience that has been on display for years. The case for India's economic strength is not built on abstract theories or future promises. It is firmly grounded in cold, hard numbers that tell an undeniable story of progress. Since SP's last upgrade in 2007, the Indian economy has undergone a staggering transformation. Back then, it was a $1 trillion economy. Today, in 2025, it has burgeoned to over $4 trillion, a fourfold increase that has lifted millions out of poverty and created a vast and dynamic middle class. This is not a fleeting boom, but a sustained expansion that has fundamentally reshaped India's place in the global economic order. The scale of this growth alone makes the 18-year gap between upgrades seem particularly puzzling. The country's growth rate consistently outpaces that of its global peers. S&P itself projects India's GDP to expand at an average annual rate of 6.8% over the next 3 years. This is more than double the projected global growth rate, establishing India as a primary driver of the world economy. Even more impressively, this performance comes on the back of an average growth of 8.8% between the financial years 2022 and 2024, a period when much of the world was still grappling with the post-pandemic recovery. This high growth differential is a key factor that attracts foreign investment, as global capital naturally seeks out markets that offer superior returns and expansion opportunities. Crucially, this rapid growth has been achieved alongside prudent economic management. Inflation, a persistent challenge for many emerging economies, has been effectively managed and anchored by the Reserve Bank of India's proactive monetary policy. The country also maintains a manageable trade deficit, thanks in large part to a strong services export sector and a robust domestic market that insulates it from the worst of global trade volatility. Perhaps most importantly, India has a perfect and unblemished record of repaying its external debt. This flawless track record is a testament to its fiscal discipline and reliability, a critical factor that should have been given more weight by rating agencies much earlier. Looking at the government's finances, the picture is one of steady improvement. The government has articulated a clear roadmap for fiscal consolidation, and it is sticking to it. The public debt to GDP ratio, which is a key metric watched by rating agencies, is projected to decline steadily from 83% in the current fiscal year to 78% by the financial year 2029. This demonstrates a credible commitment to bringing public finances onto a sustainable long-term path. When you combine this fiscal prudence with a quadrupling of the economy, stellar growth rates, and a perfect repayment history, the conclusion is inescapable. The fundamentals underpinning this upgrade are not new, but have been building for many years. The overwhelming reaction to SP's upgrade within India has been a mix of satisfaction and, well, a distinct frustration, really summed up by the phrase fashionably late. While the recognition is welcome, the central question on everyone's mind is, what took so long? For 18 years, India's rating remained stagnant at BBB-. Even as its economy quadrupled in size, its foreign exchange reserves swelled, and it undertook a series of profound structural reforms. Critics argue that rating agencies have been looking in the rearview mirror, only confirming long-established trends rather than identifying turning points and recognizing structural improvements in a timely manner, which is supposed to be their primary function. This significant lag raises serious questions about the methodologies and forecasting models used by these global agencies, especially when it comes to evaluating complex and fast-evolving emerging economies like India. The models often appear to place, excessive weight on historical data and static metrics, such as the overall government debt to GDP ratio, without giving sufficient credit to the quality of that debt, the country's growth potential, or its demonstrated resilience. India's case highlights a potential flaw in their approach: an inability to accurately price in the positive impact of structural reforms like GST, or the benefits of political stability and a strong domestic demand base until long after they have become self-evident. The purpose of a credit rating, ideally, is to provide forward-looking analysis that helps investors allocate capital efficiently. They should be able to spot sustainable investment opportunities and identify turning points in a country's business cycle. However, in India's case, the agencies seem to have missed the turn. They are now, in 2025, acknowledging a reality that has been apparent to most on-the-ground observers for at least half a decade. This reactive, rather than proactive stance really diminishes their value and can lead to a misallocation of global capital, penalizing countries that are making genuine progress with higher borrowing costs for longer than is justified by their economic fundamentals. This episode has reignited a long-standing debate about the inherent conservatism and potential biases of the big three rating agencies. For years, Indian policymakers, including the chief economic advisor, have publicly questioned the agency's methodologies and called for greater transparency and fairness. The fashionably late upgrade by S&P will only amplify these calls. It underscores the need for rating agencies to evolve their frameworks to better capture the unique dynamics of emerging markets, which are often characterized by rapid structural change rather than slow, incremental progress. For India, the upgrade is a vindication, but it's also a reminder that the guardians of global financial opinion can sometimes be the last to recognize a paradigm shift. The S&P upgrade is not just a symbolic victory, it is pouring fuel on an already burning fire of international borrowing by Indian companies. Even before the official announcement, Indian firms, particularly non-banking financial companies or NBFCs, were increasingly turning to overseas markets to raise capital. The reason is simple. It has become significantly cheaper and, more accessible. In 2025 alone, as of mid-August, these NBFCs have already raised a staggering $3.67 billion from the overseas syndicated loan market. This figure is more than double the $1.64 billion they raised in the entirety of 2024, signaling a massive acceleration in this trend. This surge represents a dramatic shift in funding strategies for many Indian companies. For years, domestic sources of capital were the primary and often the only option. However, with a more favorable global interest rate environment and a growing appetite from international banks to lend to Indian firms, the syndicated loan market has become a highly attractive alternative. This allows Indian companies to diversify their funding sources, reducing their dependence on the domestic market and gaining access to a much larger and more liquid pool of capital. It is a sign of the growing integration of the Indian corporate sector with the global financial system. Comparing the numbers year on year reveals the explosive nature of this growth. The $3.67 billion raised so far in 2025 is already 4.5 times higher than the $814 million that was raised during the same period last year, from January to August 2024. This is not a gradual increase, it is a quantum leap. The S&P upgrade will only intensify this trend. With India's sovereign rating now higher, the perceived risk of lending to any Indian entity decreases. This will likely lead to even better pricing, meaning lower interest rates, and more willing lenders, further opening the floodgates for Indian companies to tap into global financial markets for their growth and expansion needs. A recent example perfectly illustrates this phenomenon. Just last week, Avance Financial Services, an NBFC specializing in education loans, successfully raised a $200 million 3-year loan. What was remarkable was the syndicate of lenders. The deal was led by HSBC and included 11 different banks from a diverse set of countries, including Japan, Taiwan, Singapore, and the UAE. This geographic diversity shows the broadening appeal of Indian corporate debt. The deal also included a dual currency facility, with a portion raised in Japanese yen to further reduce borrowing costs. This kind of sophisticated financial structuring is becoming more common as Indian companies grow more confident on the global stage. The primary driver behind the surge in overseas borrowing by Indian companies is a fundamental change in the cost of money. A key factor here is the decline in the Secured Overnight Funding Rate, or SOFR. The SOFR is a benchmark interest rate that has largely replaced the old LIBOR system for US dollar-denominated loans. The 3-month SOFR, a common benchmark for floating-rate corporate loans, has fallen significantly over the past year. It has eased by about 100 basis points, dropping from around 5.35% a year ago to approximately 4.35% today. This 1 percentage point drop makes a substantial difference in the total interest paid over the life of a loan. This decline in the benchmark rate directly translates into cheaper borrowing for Indian firms. When an international bank lends money, the interest rate it charges is typically the benchmark rate, like SOFR, plus a spread or margin, which represents the bank's profit and the risk premium associated with the borrower. While the spread depends on the company's creditworthiness, the base rate is the same for everyone. So, when the SOFR falls, the starting point for the loan's interest rate is lower for all borrowers. This has made floating-rate syndicated loans from overseas banks significantly more cost-effective than issuing fixed-rate bonds in international markets, or even borrowing from domestic sources in some cases. The S&P sovereign upgrade will have a powerful secondary effect on these borrowing costs. While the upgrade doesn't directly change the SOFR, it directly influences the spread that banks charge on top of it. A country with a higher sovereign rating is perceived as a less risky place to do business. Consequently, the risk premium associated with all companies within that country also tends to decrease. This means that after the upgrade, Indian companies will not only benefit from the lower base SOFR rate, but will also be able to negotiate a smaller spread from lenders. This double-barreled benefit will make overseas borrowing even more attractive than it already is. This dynamic creates a positive feedback loop for the Indian economy. As borrowing becomes cheaper, companies are more likely to invest in new projects, expand their operations, and hire more people. This fuels economic growth, which in turn further strengthens the country's credit profile, potentially leading to even better ratings and lower borrowing costs in the future. The mechanics are simple. A lower global benchmark rate combined with a lower country risk premium unlocks a wave of cheaper capital. This capital is the lifeblood of business, and its increased availability at a lower cost is a direct consequence of both global market trends and India's improved economic standing. One of the most encouraging signs of a maturing market is when access to capital broadens beyond just the top-tier elite corporations. The current boom in overseas borrowing is not limited to India's largest and most creditworthy AAA-rated companies. In a clear sign of growing confidence and a higher risk appetite among international lenders, a significant portion of the funds are flowing to companies with lower credit ratings. This development is crucial, as it indicates that the benefits of India's improved economic standing are being distributed more widely across the corporate landscape, reaching companies that are vital engines of growth and employment. The numbers bear this out convincingly. In 2025, a remarkable 78% of the total $3.67 billion raised in overseas syndicated loans has been secured by NBFCs that are rated below AAA. This amounts to approximately $2.85 billion flowing to companies that, while strong, are not considered the absolute safest bets. This is not an anomaly, but a continuation of a strengthening trend. In 2024, the proportion was even higher, with 87% of the funds, or $1.42 billion, going to sub-AA rated NBFCs. This sustained interest from global lenders in a wider spectrum of Indian corporates demonstrates a deeper, more nuanced understanding of the Indian market. This trend is incredibly healthy for the economy. Mid-sized and specialized financial companies, which often carry AA or A ratings, play a critical role in providing credit to small businesses, funding consumer purchases, and offering specialized loans for sectors like education or housing. Their ability to access cheaper, more diverse sources of international funding directly enhances their capacity to lend within India. It strengthens the entire financial ecosystem, making it more resilient and less dependent on a few large players. The willingness of overseas banks to lend to these entities signals a belief not just in India's sovereign strength, but in the underlying health of its broader corporate sector. The S&P upgrade will act as a powerful catalyst, further accelerating this trend. As the sovereign ceiling lifts, it creates more room for all companies beneath it. International lenders who may have been hesitant to engage with a sub-AA rated company in a BBB country might feel far more comfortable doing so now that the country itself is rated BBB. It effectively de-risks the entire environment. This will likely lead to even greater market access for these firms, allowing them to compete more effectively and fuel the next wave of economic growth. It ensures that the benefits of the upgrade are not just confined to headline companies, but permeate deeper into the economic fabric. The S&P upgrade is far more than a technical adjustment. It is a milestone that carries immense significance for India's future. It is, first and foremost, a source of national pride. It serves as an international validation of the collective hard work, sacrifice, and perseverance of the Indian people and its policymakers through years of complex reforms and global turmoil. This recognition bolsters national confidence and reinforces India's identity as a rising global power, not just in terms of size, but in terms of economic maturity and resilience. This sense of accomplishment is an intangible but powerful asset that can galvanize further positive change and ambition. Looking forward, the upgrade unlocks tangible potential. The most immediate impact will be on investment and borrowing. Cheaper borrowing costs for the government and corporations will free up capital for productive investments in infrastructure, manufacturing, and technology, accelerating growth and job creation. It will make India a more compelling destination for foreign direct investment and portfolio investment, attracting long-term stable capital that is essential for sustainable development. This virtuous cycle, where recognition leads to cheaper capital, which fuels growth, which earns further recognition, is now firmly in motion, setting a more prosperous course for the nation's economy. However, the journey is not over. The S&P report also outlines a clear path for further upgrades, contingent on continued fiscal discipline. If India can narrow its fiscal deficits to a point where the net change in government debt falls below 6% of GDP on a sustained basis, another upgrade could be on the horizon. Conversely, any erosion in the political commitment to fiscal consolidation or a structural slowdown in growth could pose a risk. This provides a clear and powerful incentive for policymakers to stay the course on prudent economic management, using the current momentum to lock in further gains and solidify India's position in a higher investment grade category. Ultimately, this episode underscores a crucial lesson. Timely recognition by global agencies matters immensely. While India's economy grew resiliently for years without the upgrade, the fashionably late acknowledgement still withheld tangible benefits, primarily in the form of lower borrowing costs. The delay served as a penalty on the nation's progress. The final arrival of the upgrade is a victory, but it is also a powerful argument for why these arbiters of global finance must be more agile and forward-looking. For India, the upgrade closes a chapter of long overdue recognition and opens a new one filled with greater opportunity, cheaper capital, and the well-earned pride of a nation on the ascendant.